or 1% or 50% or 100% of the bonds, they're all handled the same way. So we're just going to use this cost method irrespective of the ownership. Similarly, when we get into looking at trading and available for sale securities, those distinctions go away when we start to look at these two categories, so we can group these together. So this is how our matrix is going to end up playing out. So what does significant means in general? We say again, significant means 20% or more ownership. And so under a 20% or more ownership, we're going to use a scenario. So if a company has a million shares of stock outstanding, and we own, say, 200,000 of those shares, that would be considered to be a significant influence, a significant investment. And so we would then depart from these rules normally, not always, but normally, and we would go to the equity method. Now in the next session, I'm going to go into more detail on how these work. So right now we're just trying to categorize and talk about the generalities related to the accounting treatment. But the equity method basically says, think of your investment like a bank account. So if you put some money in your bank, originally what it's worth is what you put in it. Then if you earn interest on whatever is in your bank account, its value has gone up by that amount. So if you have some interest income. So similarly, under this equity method, if you own 20% of a company and it has some income, 20% of the income is actually your income. So under the significant influence perspective, we use the equity method, which says basically the investor records their share of everything happening to the company as if it was happening to them. And again, if you sort of think about like what would go on inside a bank account, you put money in, that increased your investment. Whatever is in there, well, the amount that's deposited earns interest, that increased the value of your investment. You make a withdrawal from it, that decreases your investment. That's how the equity method works. Now, in the case of a controlling interest, which is 50.x% plus, we use consolidation. And consolidation means that we have to put the accounting records of the two companies together. But it isn't as easy as just adding everything together, because these companies may do business with each other. So company A owns company B in some kind of a vertically integrated business. So in other words, B maybe produces something that A uses. So if you put them together, you couldn't just add their sales together, because once they're treated as one company from an accounting point of view, you couldn't have sales to yourself. Right? You can't have cost of goods sold to yourself. So the key issue, I don't even know if you can see that. I better move my desk here a little bit so you can see that a little better. The key issues related to this consolidation method is that you have to eliminate intercompany transactions. So if you have A and B, right? And B sells to A, all right? So that means some of B's sales, maybe 50% of B's sales are to A. So whatever those sales are, those have got to be eliminated. So you just subtract them out, because you can't have sales to yourself. And the cost of goods sold has got to go away too, because if you don't have the sales, you don't have the cost of goods sold. So that is basically the intuition behind how a consolidation works when you put two companies or more sets of financial statements. So when you see a company's financial statement that says consolidated, whatever, income statement, that's what they're saying. The consolidation combines the companies, eliminates intercompany transactions, and so it's a combined basis. Some things can just get added together. For example, in a consolidation, you can usually add things like cash together. But what do you think about accounts receivable? How about that? Yeah, probably not. Probably there's some intercompany sales going on and there may be some receivables, and so you'd have to eliminate the intercompany receivables as well, because you couldn't owe yourself, right? There's also some tricky issues that come into effect related to consolidations. If you own less than 100%, then we have to set up a thing called like minority interest. A minority interest is whatever percentage of the company you don't own, and you have to account for that separately. It can get pretty complicated, and there's some different approaches even to dealing with how you account for minority interest. In any case, I think that gives us pretty much an overview of how we're going to categorize and treat different kinds of investments. And this pretty much captures the whole shooting match. So if you follow this here, you're in good shape. We'll end Module 3, and I'll come back with 4 in just a minute.